Hello and welcome to Module 6. Today I'm going to be walking you through asset recognition and operating assets. Some of this will sound familiar as we've touched on a few of these items in Module 5 last week and Modules 1 through 4. But let's start with an analysis of inventory costing methods. Let's see here. Okay, so the authors begin by giving us an analysis of inventory costs, and again, this will sound familiar. Inventory is capitalized on our balance sheet, which simply means that it's recorded as an asset. And typically, inventory is recorded as an asset when it's purchased, or our authors note that it's recorded as an asset when produced. Now, production of inventory would be if it's not purchased, then you might think of an agricultural or commodities firm that's either harvesting its inventory, if you're working with grains or agricultural commodities, or maybe mining its inventory if you're looking at coal or precious metals or something along those lines. Our authors note that when we look at inventory, if higher cost units are transferred from the balance sheet, then the cost of goods sold is going to be higher and gross profit is going to be lower. If lower cost units are transferred to cost of goods sold, gross profit is going to be higher and cost of goods sold is going to be lower. Now, right here with these two bullet points, we've captured the essence of the first learning objective in Module 6. So we're going to spend the next few slides talking about how the effects of the transfer of these costs work on both the income statement and the balance sheet. But these are the two key bullet points right here for Module 6. So let's move on here to the capitalization of inventory. If you focus down here at the bottom of the slide, you'll see here for manufacturers, like I mentioned, I had drawn the distinction between manufacturers and maybe miners or agricultural commodities. But for your typical manufacturing business, you have those direct raw materials which are typically purchased. And then to those, we're going to add the costs of direct labor and manufacturing overhead. Direct labor and manufacturing overhead are added to the raw materials to create finished goods inventory. Finished goods inventory would include all of those costs. Okay, gross profit margin. We've looked at this in the past. It's a simple formula. We take sales, we subtract cost of goods sold, excuse me. That equals gross profit, and then we can calculate a gross profit margin by dividing that into sales. This is probably something that you've all looked at for your assigned companies and your research projects. I want you to see how this trends over time, and then how it compares to a peer group of companies too, which can be quite insightful in analyzing your company. Okay, let's take a look at this graphic on page 6 that shows how cost of goods sold flows through to the balance sheet. We have beginning inventory, and to that we're going to add any inventory that has been acquired. Now the sum of those two equals the cost of goods available for sale. That's the total amount of inventory that we had available during the period. From that number, we're going to subtract the actual amount of inventory that was sold during the period, which, as you can see down here in the purple, is the cost of goods available for sale. Once we have subtracted that out, we get to ending inventory. You can see that ending cost of goods available for sale is comprised of ending inventory and cost of goods sold. So let's look at how we cost that. How do we transfer the cost of goods sold from the balance sheet to the income statement? So remember that it's initially recorded as inventory. Then when we sell that inventory, it moves from the balance sheet to the income statement as an expense. an expense that we call cost of goods sold. Remember that sales less cost of goods sold equals our gross profit. So it shows up on the income statement as an expense. In what amount? And there's several ways of costing that inventory. There's several ways of recording that expense. And the first one, which you'll likely remember from your accounting class, is FIFO, the first in, first out method, and we have a calculation of that up here. Inventory available on Jan 1, 500 units at $100 per unit for $50,000 balance in inventory. Then during the period we purchased another 200 units. Those units cost us $150 per unit. That added $30,000 worth of costs to our inventory balance. At the end of the period, we had 700 units in inventory with total costs of $80,000 for those inventory units. During the period, we sold 450 units. The selling price was $250, so our sales revenue was $112,500. Now, don't get confused by the selling price. I see this as a common error, and it gets me too. The selling price generates revenues and doesn't have anything to do with what we cost the inventory at. When we use the FIFO inventory costing method, we're going to take our sales, which were $112,500. From that number, we're going to subtract the cost of goods sold. Remember, first in, first out. We sold 450 units. Because we're using the first in, first out inventory costing method, those units cost us $100 each. Now, look back up here at the top with 450 units. The first units in cost us $100 per unit. We sold 450 of those units that cost us $100 each, so the cost of that inventory sold was $45,000. So we take $45,000, subtract that from our sales revenue to get gross profit of $67,500. Okay, let's contrast that to what the inventory costs would show up on the income statement as if we were using the last in, first out method of inventory costing. So this is referred to as LIFO. Same calculation. We start with 500 units at $100 per unit. We add 200 units at $150 per unit. We end the year or month with 700 units, total cost of $80,000. Same revenue number. Okay. So now when we cost our inventory sold, we're using the last in, first out method. So we're going to have to cost or assign costs to the 450 units that were sold. Well, we know that we have 200 units at 150. Those were our last in. Those are our most recent units. So we're going to come down here and we're going to assign 150 per unit cost to 200 of the units that we sold. And then for the remaining 250, we're going to look back and we see that we have to cost those at $100 per unit. So we have 250 units cost at $100 per unit. We add those up, so we have 30,000 and 25,000 for a total cost of $55,000 and gross profit of $57,500. Now compare the differences. As I back up a slide here, you can see that with FIFO, our gross profit was $67,500. With LIFO, our gross profit is $57,500. That's a difference of 10,000, almost 20%, not quite, call it 15%-ish for rounding purposes. That's a big difference in gross profit. And that's going to flow down through the income statement. That's going to be a big difference in net profit. That's going to be a big difference in earnings per share. And remember, for most management teams, that's going to be a big difference in their end of year comp, which is typically tied to earnings and earnings per share. That was one of the first assignments that we did this semester, was to find out how our management teams were compensated so that we could view all of these accounting estimates and methodologies through the lens of how the management teams gets paid, because we know with certainty that that's obviously going to be important to the people making the decisions when they select from amongst LIFO, FIFO, and other methods of inventory costing. So lastly, and probably straightforward here, is average cost. As the inventory units come in up top, we compute the average cost of those inventory units. And then when it's time to assign a cost to those units that are transferred to the income statement, we simply just assign the average cost number, which in this case was $114 per unit. That came up with a total cost of $51,000 and gross profit of $61,000. So you can see there that the average cost typically falls somewhere in the middle of LIFO and FIFO. Okay, let's look at retail inventory costing. This is really just terminology. I won't spend too much time on this. It falls underneath the broader category of managerial accounting. Remember that GAAP accounting is highly rules-based. It's handed down to us by FASB. We have to adhere to a very strict set of rules in GAAP accounting. Retail selling price, or what our cost of goods sold, what our inventory would be worth if we assigned the retail selling price to those units, is a managerial-based accounting tool, meaning that it's a very common technique that retailers will use to give them some additional insights on their business, but it's not required by GAAP. So, moving on to the financial statement effects of inventory costing, you can basically see here that our authors are laying out for us what we just went through and the different sales, cost of goods sold, and gross profit numbers for each inventory costing system. And you can see here how they vary. There's a significant variance between LIFO and FIFO. Okay, balance sheet effects. So in this example, I think we're looking at Caterpillar. Let's focus in on the footnote. And this is why the footnotes are so important here, because they give us so much information about how the accounting can affect our business. This one says inventories are stated at the lower of cost or market. Cost is principally determined using the LIFO method. The value of inventories on the LIFO basis represented about 60% of total inventories at December 14 and 15. If the FIFO method had been used, inventories would have been 2.4 billion, or 2,498 million, and 2.4 billion higher than reported on 15 and 14 respectively. Now, stop and think about what this means. Caterpillar's using the LIFO inventory costing method. If they had used FIFO, then their inventory balances would have been approximately $2.4 billion higher. So in this case, inventory balances are lower. That means that we've sent $2.4 billion worth of inventory over to the income statement as cost of goods sold. So that those numbers, that 2.4 billion has been expensed. That's 2.4 billion in lower gross profit. That's 2.4 billion in lower net profit. That's 2.4 billion that affects earnings per share, and ultimately, probably management comp. So you can see how for a company the size of Caterpillar, this has a huge effect on their income statement. So it's crucial for us to understand how this varies over time, how this affects the income statement, balance sheet, etc., etc. This footnote is called the LIFO reserve. Just to be familiar with that terminology. Okay, moving on with the cash flow effects. So we're following the money here. We just noted that 2.4 billion moved through the income statement. It's no longer on the balance sheet. That's a big difference between LIFO and FIFO. So this is our cheat sheet. Star slide number 13 here. And if you can understand these points, then you've mastered the first learning objective in Module 6. Because this is what it's all about to a financial analyst. We have to understand how the accounting affects the business. We have to understand how the accounting affects the financial statements so that we can make comparisons and inferences and forecast coming quarters. So let's just go through these one by one because it's crucial that we understand each one of them. By choosing LIFO, Caterpillar's balance, as we noted, reported inventories that were 2.4 billion lower than FIFO. Okay, so what's that mean? That means that Caterpillar's cumulative cost of goods sold was 2.4 million higher than it would have been had the company used FIFO. So that's $2.4 billion that we've passed over to the income statement. Which in turn, and this is key, those higher expenses lower pre-tax profits. And if we have lower pre-tax profits, we have lower taxes. And if we have lower taxes, then we ultimately have higher cash flows than we otherwise would have. So you can look at this a couple of different ways. You can think of it as, if management is getting compensated based on earnings, then they may be hesitant to elect to LIFO in this environment because it's going to send more expenses over to the income statement and lower earnings. Okay? If management has a significant ownership in the company and they're thinking like a true owner would, then they may elect LIFO to purposely lower earnings, because that in turn is going to lower the tax payment and increase cash flow, which is probably the better decision for shareholders, which is why it's so crucial that we first analyze how the management team is getting paid and what their incentives are, because for us as shareholders, we want them to think with our interest in mind. And the most effective way of doing that is to make sure that they are in turn compensated as owners. Maybe that's through restricted stock units, maybe that's through an options package, maybe that's through the purest way to accomplish that is just to make sure that they have a large ownership position in the company, that they really truly are an owner in the company. So I like to see that. I like to see that LIFO is being used as a tax management strategy. That gives me confidence in a management team, and it gives me confidence that they have my interests at heart when making decisions on behalf of the company. Okay, so some more terminology here. Lower of cost or market. When inventory is reported on the balance sheet, periodically we need to look at that inventory and make sure that the value is not distorted. So we just compare it to what the true market value is. And if we find out that the inventory is valued at $1 million and we could really only sell it for $500,000 based on current market prices, then we need to make an adjustment. And that adjustment is called lower of cost of market. And we will write down the value of that inventory by expensing it on the balance sheet, which is generally just a loss that we take on the value of that inventory, and we call that lower of cost or market adjustment. Okay, so let's compare different inventory methods, and this is important for those of you who are analyzing manufacturing businesses this year. I have hit on the notion time and time again that you need to be comparing the businesses that you analyze to other peer groups. Well, if you're going to do that, which we all need to be doing, then we have to make sure that the accounting is comparable. So in this example, our authors are pointing out that Caterpillar can be analyzed using LIFO, or Caterpillar can be analyzed using FIFO, and depending on what the peer is using, we may need to adjust those numbers. So be mindful of that as you're working through your research reports, and if you need to make the adjustment by adding back what we call the LIFO reserve, then do that. Just make sure you're looking at apples to apples. So with regard to that LIFO reserve, this slide number 17 shows us how we would begin to make that apples to apples comparison. And the execution of that is down here at the bottom. When we're comparing balance sheets, we would take Caterpillar's balance sheet and we would increase inventories by $2.4 billion. We would increase the tax liability by $874 million. And then we would increase retained earnings by the difference of $1.6 million, which the authors give us the calculation there. Basically just one by one reversing the effects that we just walked through a moment ago. Now with the income statement, we're going to have to back out the effects of the LIFO, FIFO. So you can see that here, whereby we look at the change in the LIFO reserve to determine the FIFO cost of goods sold as follows. And the authors give us that formula there. FIFO COGS equals LIFO COGS minus the increase in LIFO reserve. Okay, so making those adjustments allows us to compare two income statements on an apples-to-apples basis. Okay, moving on. Lastly, under this learning objective or LIFO liquidations, and here the authors are pointing out that running inventory artificially low can temporarily boost profits under LIFO. So think back to the slide we looked at a minute ago. When we have inventory costs that are rising over time, if we start to eat into those inventory balances, well, we're effectively going back in time through different tranches or different batches of inventories that we've purchased, and those are typically cost at lower and lower and lower expenses. In this example, where inventory costs are rising over time. So as we do that, we are moving less expensive inventory from the balance sheet to the income statement, and less expensive inventory leads to lower costs, and lower costs lead to higher margins. So in any given period, management may choose to eat into those more dated batches of inventory, those more dated, cheaper batches of inventory, and as they do so, you can see margins begin to rise. If this is strategic, if they're practicing some new just-in-time inventory system, then that might be a very good thing. If this is a maneuver, or if this is a move that management is using that's unsustainable, then you need to be skeptical about those higher margins. You need to have the wherewithal to know that the footnotes will point out what's driving those higher margins. And then it's your job as the analyst to ask the questions and come to some determination about whether or not that's sustainable, or if management just needed another penny in earnings per share and decided not to reload their inventory in a particular quarter. So be mindful of that. More shenanigans. We have to know how the accounting works so we can spotlight any ill effects of a management team that is using the accounting to their own benefit. Learning objective number 3, analyzing inventories and related accounts payable. Okay, so our authors here are beginning with gross profit margin, which we've already covered, and I want to make sure that everyone is analyzing gross profit margin over time and relative to their peer groups. And you can see that in this example, gross profit margin is fairly stable. I love this chart, this chart, because this is a great example of what we need to be on the lookout for when we first make observations. So in this case, if we're looking at gross margins and we see a trend, if gross margins are declining, for example, then we need to be on the lookout for, the authors give us 5 or 6 key variables here, which may or may not have some influence on declining profit margins. And this is not an inclusive list by any stretch, but it's a good place to start. And you can see that gross profit margins can result from discounting by the manufacturer, increased competition. They could result from just a recessionary environment in the economy, inventory that's overstocked, so oversupply, in an inflationary environment where manufacturing costs have increased, or maybe it's something as simple as changes in product mix. So be on the lookout for those when you see changing gross profit margins. Okay, days inventory outstanding and inventory turnover is a measure of efficiency as it applies to inventory. So the question here is, how efficiently is a management team managing their inventory balance? So we talked about this in an earlier module, and we took the time to navigate out to Morningstar and find where this is available to everyone. So It's important to know the calculation. It's likely to show up on the exam, but in practice and for the purposes of your research project, just know that it's available to you. You don't have to calculate. Just go get it, and then know what to do with it. Know how to interpret it. So let's look at that. Um, and our authors here again walk us through some examples of fluctuation in days inventory outstanding, and they give us some typical explanations. So again, product mix. A company can change its promotion policies. A company can realize improvements in manufacturing. So that's inventory quality. Here's asset utilization. I already mentioned the just-in-time deliveries from suppliers. We have improved manufacturing processes, demand pull production. So again, it's your job as the analyst to first notice what's going on and then answer the question why. And these are common answers to that question why when you see year-over-year or quarter-over-quarter changes in the average days inventory outstanding. Okay, let's look at days payable. Again, available on Morningstar. The calculation is days payable outstanding equals 365 times average accounts payable divided by our COGS. And these two bullet points at the bottom of slide number 5 are the core of the learning objective as it pertains to days payable outstanding. So we need to be able to balance the delayment of payment. We want to pay as slowly as we can pay without any secondary effects. So we're balancing the delaying payment to suppliers because that allows the purchasing company to increase its available cash, but we have to balance that against damaging those relationships with suppliers. So to the extent that we have power over our suppliers, if you recall the Porter's Five Forces module, Porter's Five Forces from Module 1, we can extend these days payable, and that serves as a source of financing for our company. All three of those, the days sales outstanding or the accounts receivable outstanding, which we've looked at in prior modules, the inventory outstanding, and the payable outstanding equates to the cash conversion cycle, which we've similarly looked at. Again, all available through Morningstar. Know this, know how to calculate it, and analyze it for your company. Recognizing all the while that the aim is to minimize this time to complete the cash conversion cycle. And we've looked at this before too, but it's important to note how an analyst uses this data. If we can minimize that cash conversion cycle, and in this example that the authors give us, we're looking at Home Depot. And you can see here that Home Depot's cash conversion cycle falls from 51 days in 2002 to 40 days in 2016. Let's look at the magnitude of that. So that reduction of 11 days has allowed Home Depot to increase its cash balance by 1.7 billion, or 1,700 million. So 1.7 billion in excess cash that we've been able to wring out of the balance sheet through efficiencies. That's not a small number, and I'm sure it resulted in a very, very nice Christmas bonus for the analyst who figured out how to do it. Just take 1.7 billion and multiply it times whatever percentage rate you get by investing that in your bank account. So you could probably get a percent on that. So 1.7 billion times a percent, well, right there you have, what's that, $17 million in interest that you're collecting on an annual basis. That's worth not just one analyst's time, but a whole team of analysts' time in figuring out how to do that for a company like Home Depot. And these are the types of jobs that are available to you after graduation. So know the accounting, know the effects, know how to engineer those effects, and you can be in very high demand to some of our Fortune 500 companies like Home Depot. Okay, moving on. Let's go through the same analysis for capitalization and depreciation of PP&E, or rather we're going to go through the same analysis for PP&E, but first we're going to look at depreciation and the effects of depreciation on PP&E. And this should be familiar from your first accounting class, but just note that PP&E is recorded at cost on the balance sheet, and that's called capitalization. So getting anything onto the balance sheet is referred to as capitalization. And it, specifically as it pertains to property, plant, and equipment, you'll hear those expenditures referred to as CapEx. So the terminology is challenging and so important to get right as we try to analyze our research projects for the semester, because you'll hear these terms used by management and you'll hear these terms used by analysts, and it's just important that we understand what they mean and where they go basically on the financial statements. Now, once we get that PP&E on the financial statement, on the balance sheet, over time, if that's a building and we pay $1 million for it today, well, it's going to depreciate. It's not going to be worth $1 million next year. And that depreciation, or basically the lowering of the value of that asset over time, which happens to all assets, needs to be recorded. And that's recorded with an expense called depreciation, which we book on an annual basis or quarterly basis on the income statement, and that serves to lower the value of that asset on the balance sheet. Okay, let's look at how that unfolds. To put this transaction into effect, we need to again familiarize ourselves with some terminology, and this should be familiar to everybody in class. Useful life, salvage value, and depreciation value. So the useful life is self-explanatory, just how long do we expect to use the asset. For autos, that's typically 10 years. For buildings, that's typically 20 to 30. The salvage value is what we expect to be able to sell that for at the end of the useful life. So there will be some residual value. Typically, we need to estimate that and know what it is in order to calculate our depreciation. And then lastly is the depreciation method. There's several methods, and we're going to go through a couple of them here. The simplest and most straightforward is called the straight line method. So to determine the straight line method of depreciation, we're going to begin with the cost of the asset. We're going to note the salvage value, which in this example is $10,000, and then we're going to identify the useful life, which in this example is 5 years. So using the straight line method of depreciation, we're simply going to take the cost of the asset less the salvage value, and then we're going to divide by the useful life. So 100,000 was the cost. We're going to subtract the salvage value. That gives us a $90,000 depreciable base. 90,000 is the amount of depreciation that we're going to run through the balance sheet. And we're going to do that over a period of 5 years. So we're going to take 90,000, we're going to divide by 5, or identify the percentage that we're going to depreciate every year. So dividing by 5 is the same thing as multiplying by 20%. That's our depreciation rate. And that comes up to $18,000, which we would enter on our income statement, or if we wanted to use the financial statement effects template, you can see here that we would have a depreciation expense, and the contra credit would be an $18,000 credit to accumulated depreciation. Now, accumulated depreciation in this case is referred to as a contra asset account. When we look at our balance sheet, we're going to see the original asset as it was booked at historical cost, and then right underneath that we're going to see accumulated depreciation, which is a contra asset account, which subtracts from the total value of that asset, and the resulting net shows up as the net book value of that asset. So we keep track of the original cost, we keep track of the accumulated depreciation, and we keep track of the net book value of that asset over time on our balance sheet. Okay, let's look at the second method of depreciation, or booking depreciation expense, which we call double declining balance method. Now, for this method, you need to be able to go through that exercise that we just went through of calculating the depreciation rate for straight line. So in the prior example, we noted that the useful life was 5 years, and that resulted in a depreciation rate of 20% per year. Okay, once we have that, we can now calculate the double declining balance method because it's just as simple as taking that 20% rate, whatever straight line would indicate, and doubling it. Hence the name double declining balance. One other key difference is that we begin with the net book value of the asset, which means that we don't take salvage value into account. We just apply the double rate, the double declining rate, to the original net book value. So the double rate is 20 times 2, which equals 40, and we're going to apply that to the original book value of 100 to get our depreciation expense in that year, which is $40,000. The credit in that transaction would be a $40,000 credit to accumulated depreciation, and you can see there that at the end of the first year, the net book value of the machine is $60,000. Now roll this over to the second year. In year 2, we're going to take the same rate of 40%, but in year 2 we're going to apply that to the net book value of the asset. So in year 2 we apply the 40% to the 60% net book value of the asset, which is, let's see, 10% would be 6,000 times 4 is 24,000. So our depreciation expense would be 24,000 in year 2. Contrast that to year 1, which was 40,000. And now you can begin to see the difference between straight line and double declining balance, where straight line kept that depreciation expense constant throughout the depreciation period. Double declining balance is going to begin with a very high depreciation expense in year 1. Year 2 is going to be somewhat less. Year 3 is going to be somewhat less. And year 4 is going to be somewhat less. It declines significantly over time. That results in more expenses during the early years of an asset's life and fewer expenses during the later years of an asset's life. And this is something that we as analysts need to be familiar with, because anytime management team has the flexibility of choosing between one accounting method and another accounting method, it's going to have different effects on our financial statements, and we need to be able to compare and contrast. So let's compare and contrast. As we look at the tax and cash effects of depreciation. So we've noted in the past that the IRS allows for different accounting methods when we submit the books to the IRS. So most companies keep 2 sets of books, one book for GAAP accounting and one book that they use for the Internal Revenue Service. And this is one of those areas where it's acceptable for a management team to elect one form of accounting for GAAP and another form of accounting for the IRS. So that's obviously going to affect our the calculation of our tax rate and the taxes that we pay. So at least as it pertains to the IRS books, it would make sense to show the highest expense number that we possibly can when reporting depreciation. And we just went through 2 examples and noted that double declining balance produced a higher expense calculation. So it's very common for management to elect double declining balance for the IRS books and straight line or another method for GAAP. So we need to be aware of that and familiar with that. This is the key point. Even though this relation reverses in later years, meaning that in later years, if we use double declining balance, the depreciation is lower than straight line, so the taxes would be higher. Companies prefer to have tax savings sooner rather than later, so that the cash savings can be invested to produce earnings. Okay, I think when you go through the examples once or twice and spend just a few minutes thinking about the effects that differing depreciation methods have on the financial statements, that point becomes a little more clear. What I'm going to refer to as a more advanced understanding of the accounting and the business model is down here in point number 4, and this one is advanced. Let's just read it here. It says, further, the reversal may never occur if depreciable assets are growing at a fast enough rate. The additional first year's depreciation on newly acquired assets more than offsets the lower depreciation expense on older assets, yielding a permanent reduction in taxable income and taxes paid. So think about this from the perspective of a Fortune 500 company. Maybe it's Home Depot that we were just looking at a few minutes ago. From the perspective of a single machine, yes, 0.3 holds above. But if a company's growing and expanding its presence and footprint, maybe from one manufacturing center to 2 to 3 to 4 to 5, then the effects that we just looked at a moment ago when choosing among depreciation methods for a single machine, well, now those effects are multiplied in year 2, year 3, year 4, year 5. It's like a waterfall of cascading depreciation expense that continues to get pumped through the income statement as we keep buying more and more and more property, plant, and equipment. The accelerated effects of that depreciation in their first years or second years on our balance sheet creates a somewhat permanent effect of what our authors call lower taxable income and taxes paid. Now, realistically, this only applies as long as that company's growing. And we know from our management classes at the Block School that there's a growth curve that most companies climb, and companies reach a mature status sooner or later. And that's the point where you would see this reverse. But that can take a period of years, if not decades, which can have a very meaningful effect on the valuation of a company. So it is worth analyzing. So just kind of recognize that, think about that, and hopefully that becomes more intuitive as we spend more time working with the financials. Okay, depreciation of R&D and property, plant, and equipment. Some minor points here. Research and development costs are typically expensed, with the one exception that the authors note here is that if research and development facilities and equipment have a specific use, meaning that we're not buying property, plant, and equipment that can serve other purposes, then it's acceptable for us to expense that specific PP&E in year 1. Okay, learning objective number 5. So let's evaluate asset sales, impairments, and restructuring activities. Talked a little bit about restructuring activities in Module 4 as non-recurring costs, so we'll touch on that again, but first let's look at asset sales. So for an asset sale, the authors just note here that anytime we sell an asset, we have to true up the accounting for the value at which we sold the asset versus the value at which the asset was on our books. Because any difference in those two numbers is going to result in a gain or a loss. If we have an asset on our books, a manufacturing plant or facility or machine or truck or building or whatever, and we have that booked on the balance sheet at $1 million and we sell it for $2 million, well then we just recorded a gain of $1 million. Or if we have it on our books for $1 million and we sell it for $500,000, we just recorded a loss for $500,000. Pretty simple stuff. And that, if it's a loss, well, I'm getting a little bit ahead of myself here. Let's look at asset impairments. Oh, I skipped 2 slides. Okay, we went from asset sales. Here's an asset sale. So authors give us an example of Hilton Worldwide, and I want to stress the importance of checking the footnotes here, because you only get this level of detail if you just thoroughly pour through and analyze those footnotes. So make sure you're spending time with these when you look at your 10K filings. In this example, Hilton sold the Waldorf Astoria. In February 15, we completed the sale of the Waldorf Astoria in New York for a purchase price of $2 billion. So next time you're out in New York and lucky enough to be staying at the Waldorf, just kind of look around and think, that's what $2 billion will buy you. So as a result of the sale, Hilton recognized the gain of $143 million. So if we just back out the effective taxes or make the simplistic assumption that they don't apply in this case, then we can see how that property would have had a book value of 1.8, about 2 billion lower. So the book value was 1.8, they sell it for 2, they're going to need to book a gain of, approximately 200 million. And that's how that would hit the income statement. Asset impairments are similar, but they don't necessarily represent a sale. They just represent an honest, up-to-date look and accounting of our balance sheet. And the auditors will do this on an annual basis. They'll test the assets on our balance sheet to make sure that they're still worth, ballpark, what we say they're worth. And if there's any significant deviations from that, say we have some old inventory that's obsolete, or some, in this example, property, plant, and equipment that's obsolete, then we'll take an impairment charge. And the calculation for that is down at the bottom of slide 40 here. The auditors will look at the sum of undiscounted expected cash flows, and they'll compare that to the book value of the company. And just focus in on this word expected. Every time you hear the word expected, just know that there's an estimate involved in that, and that brings into the equation an inherent level of subjectivity, and that should kind of raise red flags, or at least pink flags, to a good financial analyst, in that subjectivity introduces the opportunity for error and or just improper misdoings or otherwise shenanigans. So, okay. Another example that the authors give us here is the impairment of some oil and gas properties that Chesapeake Energy took in 2015 to the tune of about $18 billion. In this example, in order to determine the impairment charge, the auditors took a look at other properties and the fair market value of those other properties. So you can look at, if you can pull together a comparable universe of recent sales, then you can get a rough estimation of what the market is truly bearing in terms of cost for properties, and you can use that to mark to market other properties, like in this case Chesapeake's oil and gas. Okay, restructuring costs. We talked about these in Module 5 as being non-recurring. In Module 6, we're going to talk about the actual accounting for this. And I advised when we were in Module 5 that you look skeptically on restructuring costs, as they are meant to be non-recurring. But as you look back over time, too often is the case that you'll see restructuring costs as a recurring line item on management's income statement. And management teams that take restructuring costs year after year after year after year should be held in I was going to say suspect, but maybe even contempt. Just look at that with a very suspect eye, because restructuring costs are meant to be non-recurring. Yes, and I think we touched on all of these major points in Module 4. Let's talk about the accounting. So to accrue for employee severance, relocation expenses, so on and so forth, first the company has to estimate, there's that word again, estimate. Company has to estimate the total costs of terminating and or relocating selected employees, and then report those total costs as an expense. So keep in mind, we haven't paid this out yet as cash. We're recording that as an expense as soon as the restructuring is declared. So severance, relocation, restructuring. With major Fortune 500 businesses, these types of things can take quarters, if not years. It's not uncommon for a restructuring program to take 2 quarters, 3 quarters, 4 quarters, up to a year, sometimes more. But we're going to expense it as if all of those expenses hit the income statement today, or in the period that those restructuring expenses are announced. And then the offsetting accounting entry is going to be to book a liability on the balance sheet. And then that liability will reverse itself in subsequent periods as we actually pay that cash out to employees in the form of severance or relocation or whatever. Okay, the authors give us an example of this when restructuring costs are announced and when restructuring costs are paid out over time as this transaction occurs and the liability that we originally booked is reversed over time, you'll see this disclosure in the footnotes of your 10K filing. So be on the lookout for this disclosure. It gives you kind of an up-to-date progress report on how those restructuring expenses are being paid out and how that liability is reversing itself over time. Now, as we analyze this, I want you to similarly be mindful that that original estimate that we made is not going to be accurate. Estimates never are perfectly accurate. We hope to get them as close as possible, but there will be either an overstatement or an understatement, and it could be the case that that overstatement or understatement is significant. And if it is, recognize that any overstatement in those restructuring costs will reverse itself over time, and as it reverses itself, the expense that we originally recorded will be a reduction to the liability. So we didn't spend as much as we thought we were, and therefore the original expense was overstated, and we will put that back onto the income statement in a reversing entry that will show up as a gain or a reversal of that initial expense. So in the subsequent period, when we come to the determination that our estimate was too high, that will show up on the income statement as a gain, and that will flow through to net income, and that will flow through to earnings per share. If the original estimate was too low, exactly the opposite will unfold, and we will have to book additional expenses to account for the understatement of our original estimate. So be familiar with how that accounting works, and then also be mindful of asking yourself the question of whether or not your management team might have a reputation for getting these estimates right or wrong. Okay, moving on to asset write-downs. Write-downs are reflective. Anytime you see an asset write-down, and I talked about this a little bit in Module 5 too, anytime you see an asset write-down, it's reflective of poor decision-making on management's part. And perhaps the most primary example of this is with mergers and acquisitions. Say a management team buys a competitor, and they spend, I don't know, round numbers, $1 billion for some in a merger or in an acquisition. Well, that acquisition is going to go on the balance sheet as an investment in company XYZ, and its book value is going to be $1 billion. Well, fast forward 2 or 3 years, and we may come to find that that original investment has not panned out like we thought it would. For whatever reason, that market dried up, or it was just a really bad decision on management's part. The accountants come in, they take a look at that asset, and they say, this isn't worth $1 billion. This is not accurate. We need a write down, and that write down is going to show up as an expense on the income statement, or a loss rather. It's going to show up as a loss on the income statement. It's going to reduce net earnings. It's going to reduce earnings per share, and that's all I had in my notes. So as long as you can understand those key points, then you have the gist of asset write-downs. Okay, number 6, analyzing tangible assets and related activities. I mentioned a few moments ago that we were going to look at the PP&E turnover rate like we did the inventory turnover rate, and this is just another method of analyzing efficiency. We looked at how efficiently we were managing our inventory. We want to look at how efficiently we're managing our PP&E, and to do that we're going to take sales and divide by average PP&E to compute PP&E turnover. So we have that number. We're going to look at it across time to see whether it's rising or falling. We're going to look at it relative to our competitors, and this is going to give us different insights into the company. And then we're going to ask, well, why is that? What's causing that PP&E turnover to to go up, to go down, what's causing a favorable number relative to our competitors. And you can see here that I just note this last point. PP&E turnover, it's going to be lower for capitally intensive manufacturing companies, which that's just the math, right? The more property, plant, and equipment we have, the larger that number, the fewer times we're going to be able to divide that into sales. But for a service business, or for, so as most of you know, I work in the financial services industry. 2 West, our company, we service wealth management and financial plans. Our infrastructure is a computer and a desk and a monitor. Very, very capital, not capital intensive, but the opposite of that, I guess you'd call it capital light. We have an extremely high property, plant, and equipment turnover. So the nature of the business will have a lot to do with this ratio too. Okay, these last 3 slides are primarily terminology, and it's a different way of looking at property, plant, and equipment that's separate and apart from depreciation, because depreciation expense that we looked at just a few moments ago may or may not give us an accurate indication of the useful life and value of the property, plant, and equipment that we currently have on our books. So that it can result in distortions, which is why, as an analyst, we may want to take a look at property, plant, and equipment and ask ourselves, well, what's the useful life? And then our authors note that for land and construction in progress, depreciable assets don't apply. But once we know that useful life, we can calculate the percent used up, and we can compare, contrast this to what has actually been depreciated. So if we know that depreciation may indicate that 100% of the asset has been depreciated, but the percent used up, or this calculation, may indicate that, well, okay, just because we've depreciated the asset fully doesn't mean that we're out of useful life, or doesn't mean that we can't still use that, because it's very common for companies to fully depreciate an asset but still have 50% of the capacity of that asset or opportunity to use that asset left in it. So we just need to be able to understand that difference as financial analysts. And those were the last 2 slides. So that's going to take us to the end of Module 6, and we'll cover Module 7 next week. So thanks for tuning in. I hope this helps. Feel free to reach out to me via email or through Blackboard with any questions. That goes for questions on your homework as well, and I'll try to be as responsive as I can. So thanks again.